potentially silver could, let's say, stay in a range close to around 70 and maybe stay there for 2 months. Not impossible. We have seen these things happen before. I would say that, yes, I could easily see a sharp correction. In London, there was very high physical tightness in London where most of the ETF silver is held. It was becoming impossible for them to make deliveries. Inventories in China had reached 10-year lows. Likely, significant inventories were shifted from Shanghai to London. We call a shell game. Well, in this case, it's where is the silver? And no matter how much you move the silver around, it doesn't mean you have more silver. You just change the location. Most of the consumption is east. Places like China and India are huge consumers of silver. What they pay for silver will ultimately determine a world price for the metal. It's very difficult to mine silver. Only 25% of mined silver comes from primary silver mines. 75% of mined silver comes as a byproduct of mining gold, copper, lead, and zinc. This is a massive move, even for silver, which can do this, as we know from history. But it is massive, and this year alone, as you said, about 140% return. This is, I think, I want to caution people, not something you should expect every year. And in fact, if we got that every year, the bull would be over probably quite quickly, and we don't want that either. But as you said, I think it's definitely a clear sign of physical tightness. We saw this start, in fact, well, you and I have talked about this before, but I started signaling this issue back in early 2024, saying that for me, the main reason that the silver price was really seemed capped at maybe $28, $30 was because there were these large secondary inventories, produced silver just sitting above ground in bar form at the major futures exchanges like Shanghai, LBMA, COMEX. And the big consumers were able to go and buy a long contract, futures contract, and stand for delivery, take delivery of that silver when their contract matured. And because this silver was already produced, already sitting above ground, sitting in inventory, this did not put pressure on the silver price because miners didn't have to try to bring more to market.
A 140% annual move sounds explosive, but the real story is why silver stayed capped for so long before breaking free. As Peter Krauth has consistently argued, prices were suppressed not by weak demand, but by bloated above-ground inventories sitting on major exchanges like COMEX and the LBMA. That stockpile acted like hidden supply, letting industrial buyers meet demand without forcing miners to increase production. Once those inventories started draining in early 2024, the cap disappeared. For investors, this reframes the rally as a structural shift, not a speculative spike, and that distinction matters for how long this trend can persist. Peter Krauth discusses what comes next depends on whether this supply cushion is truly gone.
You didn't have to try to draw more silver out of maybe private holdings of silver through a higher price. So, but I said that, based on the decline that we saw, significant decline from early 2021 up until, let's say, late 23, early 24 in these inventories, that if at this pace, it could only continue maybe 12 to 18 months. So I think what we saw starting about a year ago with the silver price really starting to rise. So the bottom, let's say in recent years, was about 2024 in February. It was $22. It has really risen quite significantly since, but really took on new life this year. And at the end of last year, I think, this combination of the market being tight and then this threat, uncertainty around tariffs, where especially in the U.S., traders and so on were worried that if they had to deliver silver to contract holders, that if that silver had to come from offshore, that it may be taxed because of tariffs. So that would cost them. So they wanted to get the silver into the U.S. before potential tariffs. So, that moving the silver around doesn't change the tightness, but it does reflect I guess the need to be nimble and to react.
This is where the tariff narrative quietly exposes market stress. Inventories fell steadily from 2021 through early 2024, and Peter Krauth flagged that math early, At that pace, the buffer only lasts about 12 to 18 months. When silver bottomed near $22 in February 2024, traders weren't suddenly bullish. They were defensive. The scramble to move silver into the US ahead of tariff risk wasn't about profit. It was about avoiding delivery costs. Headlines frame this as logistics, but logistics don't matter unless supply is tight. For investors, that's a warning sign. Tight markets move fast and punish complacency. Next, Peter Krauth talks about how stress migrates when inventory games stop working.
And we were seeing big deliveries from those exchanges. So this was going into sort of privately held warehouses. It was not shifting all from one exchange to the other. And then, after at that point, so let's say a year ago, we were already into the third year of massive central bank buying of gold, to the tune of nearly 1 out of every 3 ounces of gold that came from mining each year for the last 3 years went to central banks. So they know something. You can't. I often say, do as they do, not as they say. And so they've been buying a lot of gold, and we know also from history, and I talk about this in the book, that silver outperforms gold over the longer term, but in the shorter term it underperforms, and then eventually it catches up, and then it surpasses. And I think that people who have been following gold and see it at $4,000, $4,500 now almost, and staying at these sustained high prices, are saying to themselves, wow, maybe I need exposure to gold, but $4,500 US for one little coin is a lot of money. So what are my alternatives?
When metal leaves exchanges and disappears into private warehouses, that's not routine, it's strategic. At the same time, central banks have been absorbing nearly 1/3 of annual gold mine supply for 3 straight years, a stat most retail investors overlook. As Peter Krauth points out, central banks rarely chase tops. They position early and quietly. Historically, silver lags gold in the early stages, then overshoots later. With gold priced out for many investors near $4,500 per coin, silver naturally becomes the pressure valve. Portfolio-wise, this is about accessibility meeting macro reality. Next, Peter Krauth talks about whether silver is still early in that catch-up phase.
And silver has always been that natural alternative. So it's an inflation hedge the way gold is, and it's, affected by these other things that I mentioned before. So as I say, all of this has come together and produced quite the bull market in silver.
Excellent overview, Pete. But given the parabolic nature of this rally, is there a risk that silver has outrun its fundamentals in the short term? I mean, potentially setting up for a sharp correction?
So I would say possibly, yes. I would not deny that possibility at all. In fact, even through this summer and through the fall, as it was going through $35, $40, $45, and $50 ultimately in October, I personally felt like it was advancing too quickly. But the market, was right, because we're at 70 now and that was 45. So I'm assuming, that was right. But I think that it signified a lot of pent-up demand that was on the sidelines, cash, people who were watching, waiting, and each time you had a small pullback, it was being bought. Same for gold.
Parabolic charts make people nervous, but speed alone doesn't invalidate fundamentals. Silver's move from $45 to $70 feels extreme, yet every shallow pullback has been met with aggressive buying, a classic sign of sidelined capital rushing in. Peter Krauth's caution here matters. Markets can be right on direction, but wrong on timing. We saw similar behavior in gold ahead of prior consolidations, not collapses. For investors, the risk isn't that silver is worthless at $70. It's position sizing and entry discipline. Chasing vertical moves is how long-term theses get damaged. Up next, Peter Krauth talks where corrections can hide without prices actually falling.
Small pullbacks just attracted more money, and it was never really sort of allowed to fall very much. Then we got a correction in October, a little bit after it reached, I think it was 54 or 55. was a meaningful correction, dropped to, I believe it was high 40s, and that's the lowest we've seen so far. But I do agree with you that yes, in fact, I was just reading yesterday some research that suggests that you could, there's different things you can look at. One of them is the silver futures in the U.S. and there's what we call smart money and speculators. With not say dumb money, but speculators, and the speculators are very long silver, and this is typically a sign that it has gotten somewhat overheated. So yes, I would say yes, there is, especially now at $70. This is also, psychologically, it's a milestone level. $70 is, all the round numbers are kind of a big deal. The round and the fives, 70, 65, 70, they're all kind of big deals, and but 70 is a big number, and especially given where it has been over the last couple of years, and a new all-time high record.
This is where momentum quietly turns into crowd risk. When speculators are very long, as the futures data shows, history says upside becomes fragile, not stronger. SEOT reports have repeatedly shown that extreme speculative positioning often precedes corrections, even in strong secular bull markets. Peter Krauth has warned that silver doesn't collapse at tops. It overheats first. The $70 level isn't magical because of fundamentals, but because psychology clusters orders there. For investors, this is where discipline matters more than conviction. Next, Peter Krauth explains why corrections don't always look like crashes.
I would say yes, there's significant chance that we would get a correction. It could be, it could take any form. It could be quick and small. It could be quick and deep. It could be more drawn out. You could get a drop and then it moves sideways, or it could even peak at 70 and move sideways, and it could consolidate. People need to realize that you can get price corrections over time, not only in the number. So I'm not saying this will happen, but we've seen these kinds of things happen before. Let's say now, potentially, silver could, let's say, stay in a range close to around 70 and maybe stay there for 2 months, 3 months. It's not impossible. We have seen these things happen before. But if I had to go maybe with instinct, I would say that, yes, I could easily see a sharp correction. We're near the year end. There's a lot of things going on. There's also a lot of people maybe not paying attention to the market. Makes it easier to push around. And so my sort of best guess would be a small to medium correction.
Most investors think corrections only happen through sharp drops, but markets often correct by doing nothing. As Peter Krauth points out, time can bleed off excess just as effectively as price. We saw this in gold during 2021, where long sideways ranges reset positioning without headlines screaming crash. Thin year-end liquidity makes metals easier to push around, especially when attention shifts elsewhere. For portfolios, that means patience beats prediction here. Chasing breakouts during low liquidity periods is how risk quietly compounds. What matters next is who steps in when prices stop moving.
Not necessarily very long term. I still think there's a lot of pent-up demand waiting to go and buy on corrections. And then perhaps that would last a matter of a few weeks, a month, and then we'd be back to climbing again, hopefully steadily climbing.
Yeah, our next interview will show if you were right or wrong. But
Exactly.
I agree with you, by the way, full disclaimer.
This is the part most headlines skip. Demand didn't disappear. It's waiting. Silver ETFs, physical dealers, and even miners have seen steady interest whenever prices dip, not panic selling. Peter Krauth's framing matters. A pause isn't bearish if buyers are disciplined, not euphoric. For long-term investors, this argues for staged entries instead of all-in bets. Corrections are where allocation decisions matter, not at record highs. Next, the conversation turns to whether manipulation myths distract from a bigger reality.
Pete, critics argue that silver price is heavily manipulated through futures markets. Given the record highs, do you believe we are witnessing a breakdown in traditional suppression mechanisms, or this really is a moral function of a genuine physical shortage?
So again, I would have to say both. I mean, I do believe that yes, there's been, and for me at least, any sort of suppression I feel can happen on a very short-term basis, not on a longer-term basis. And when people ask me about that, I always point to silver was $4 and change in 2001, and it went to $49 in 2011, 10 years later. So that's a 10 times return. So it was manipulated which way at that point, but again, I do believe in the short term, this is possible that it happens. Frankly, for silver to now be well beyond its previous all-time 45-year high of $50, and one of the things that I think for me suggests strongly that yes, there is absolutely physical tightness. It is the fact that we've heard even from some of the more, let's say, mainstream or conservative outlets that report on these things.
Blaming manipulation is emotionally satisfying, but it often misses the real signal. If silver can rise tenfold from 2001 to 2011, long-term suppression clearly isn't absolute. As Peter Krauth notes, manipulation works best in the short term. Inventory and supply decide the long term. What's different now is mainstream acknowledgement of physical tightness, especially in core vaulting hubs. That's not internet speculation. That's institutional stress. For investors, the risk isn't manipulation. It's ignoring when fundamentals overpower it. Next comes the data that exposes how thin the physical buffer really is.
That in London, physical tightness was very, very, there was very high physical tightness in London, where most of the ETF silver is held. And so it was becoming impossible for them to make deliveries, which doesn't look good for a futures exchange. And so we also saw from research that inventories in China had reached 10-year lows. And I believe those are perhaps all-time lows for them because their exchange hasn't been around all that long. So it's assumed that likely significant inventories were shifted from Shanghai to London. And I compare this to what we call a shell game. So you have shells and you have, let's say, a ball under, you have 3 shells and you have a ball under one of them, and you move the shells around and you have to guess where's the ball. Well, in this case, it's where is the silver. And moving it, no matter how much you move the shells around, there's still one ball. And no matter how much you move the silver around, it doesn't mean you have more silver. You just change the location. And I believe that's kind of what had been happening. So it's a combination of those two. And, we've heard, I think, many contributors and commentators say things like price discovery is moving east.
This isn't a shortage headline. It's a delivery stress warning. When London, the backbone of ETF storage, struggles to source metal while China hits decade-low inventories, that's not coincidence. It's strain moving through the system. As Peter Krauth has argued, relocating silver doesn't create supply. It exposes how thin global buffers really are. The shell game metaphor matters because futures markets price abundance, while inventories quietly migrate east. For investors, this signals price discovery, shifting away from paper promises toward whoever controls physical flow. Next, Peter Krauth explains why this shift makes Western pricing models increasingly fragile.
And I believe that. And for the main reason that most of the consumption is east. Places like China and India are huge consumers of silver. So I think it's normal and natural that what they pay for silver will ultimately determine a world price for the metal.
Yeah. Pete, how do these inventory drains compare to historical precedents, such as 2021 silver squeeze attempts? And could they foreshow a delivery default or forced short covering by bullion banks?
So it's funny because when I started my newsletter, it was actually January of 2021. And I remember very well that silver squeeze, which was right at the end of that January. And I told my subscribers, I said, this is not something that's fundamental. There's plenty of silver available, and it's purely sentiment because you had these meme stocks that were going crazy, GameStop and so on. And somebody, I think it was on Reddit, suggested that people should buy silver to squeeze out silver shorts. And so that's basically what took place. It was a phenomenal occurrence. It lasted a matter of a few weeks. And I said, let's not expect this to last because there's no basis really for it.
This is where the comparison breaks down. And that matters. The 2021 silver squeeze was sentiment-driven, not supply-driven, fueled by retail momentum after GameStop, not inventory depletion. Peter Krauth correctly separated noise from fundamentals back then, and history proved him right when prices faded within weeks. Today, consumption dominance from China and India changes the equation entirely. When buyers who actually take delivery set the marginal price, paper leverage loses power. Investors should recognize this isn't a replay, it's a structural shift. What follows explains why this time the math no longer resets easily.
It pretty much played out that way. I think it's not the case this time. We do have shortages. We had surpluses on balance from, I believe, about, say 20, from what we see in Silver Institute reports, for 5 to 10 years prior to 2020, 2021, we had surpluses. So we were consuming less silver than we were producing. And these surpluses would end up in the futures exchanges, in their inventories. Ever since 2021, we are in structural deficits. And this year will be the fourth consecutive year. The World Silver Survey that's put out by the Silver Institute forecasts that the next 5 years, we will not only see ongoing structural deficits, but we will see new record high deficits. Simply because, even if demand were to stay where it is, or even frankly drop a little bit, the production is not meeting demand by any stretch of the imagination. We had maximum production of silver back in 2016, so 10 years ago was the last time silver mine production peaked. It was 900 million ounces. We have not been able to, we've averaged over the last 5 years, we've averaged about 830 million ounces.
This is the data Wall Street rarely emphasizes. The cycle flipped in 2021 and never flipped back. After years of surplus feeding exchange inventories, silver entered structural deficits, now 4 years running. The Silver Institute projects record deficits ahead, even if demand softens, which exposes how fragile supply really is. Mine production peaked in 2016 at 900 million ounces and has stagnated since. For investors, this means rallies are no longer fueled by speculation alone, but by a shrinking physical base underneath paper markets. Next, Peter Krauth explains why higher prices don't automatically fix this problem.
So we're not even close. And the forecast is mine supply will stay flat, maybe up 1% or so if you're lucky, in a year or two. But demand is not expected to drop significantly, and it's to the tune of 10 to 15% above supply. And so that's why they expect these deficits to continue for several years. And we can go into all kinds of reasons why, these deficits are likely to continue. Mining silver is very particular and really actually different in many ways from other metals. And that just makes it what I call supply inelastic to price. If the price of silver rises, you do not have, like in a typical economics 101, there's a huge demand for some product. Well, the manufacturer will just go and make more and bring it to market, and that will meet the demand and sort of, help balance the price out. This doesn't happen in silver.
This is where textbook economics quietly fails. Even with prices rising, silver supply barely responds. Forecast growth of 1% doesn't offset demand running 10 cents, 15% higher. Peter Krauth's point on supply inelasticity matters because it explains why deficits persist despite incentives. Unlike tech or manufacturing, mining can't scale on command, especially when new projects take years and capital. For portfolios, this changes risk modeling. Volatility doesn't resolve imbalance, it exposes it. Next, the structural bottleneck gets even tighter.
It's very difficult to mine silver. Only 25% of mined silver comes from primary silver mines. 75% of mined silver comes as a byproduct of mining gold, copper, lead, and zinc. So these producers of other metals, including silver, have little to no interest in trying to produce more silver if the price of silver goes up, because the amount of silver they produce and its meaning to their revenue stream is so small, they just are happy to accept a higher silver price for what they already produce.
This is the quiet choke point most investors miss. Since 75% of silver comes as a byproduct, higher silver prices don't trigger new supply decisions. Copper, gold, and zinc producers optimize for their primary metals, not silver margins. Peter Krauth highlights why price signals fail here. Silver doesn't control its own production destiny. For long-term investors, that means scarcity compounds over time instead of self-correcting.